Hey everyone, Steve here, your teacher for all things finance. Today we're talking about the major money milestones you should aim to hit in your 20s if you want a strong financial foundation for the rest of your life. The habits you build right now will determine your wealth for the next half century, and I promise you, it's not as complicated as some people make it out to be. We're going to break down the key steps into actionable, manageable goals that anyone can follow. Before we jump into the details, don't forget to like this video, leave a comment about your biggest financial goal, whether it's paying off a student loan or saving for a down payment, and of course, subscribe so you never miss a future lesson. Your support helps this channel reach more people who need these essential skills. Alright, let's get into it. One of the absolute first money milestones in your 20s is dealing with debt, or ideally, avoiding it altogether. This is crucial because debt acts like a fierce headwind, constantly pushing against your efforts to build wealth and compounding against you. A lot of people start out with student loans or even credit card debt from their late teens or early 20s. And while you'll probably hear arguments about investing instead of paying down loans, because the stock market averages 8%, remember this crucial distinction. Investments can go up or down based on market conditions, but loan interest is guaranteed. If you have a credit card charging you 20% interest, that is a guaranteed 20% drain on your money. And when you pay it off, that's like a guaranteed 20% risk-free return on your money. No investment on earth can promise that level of security and return. Paying off high-interest debt early gives you incredible peace of mind, and more importantly, it frees up your future cash flow so you can take smart, calculated risks later on, like investing in the stock market or starting a business. Think of clearing that debt as the highest return investment you can make right now. Use a method like the debt avalanche, where you pay off the debt with the highest interest rate first, regardless of the balance size. It's also worth thinking twice before taking on large student loans if you haven't started college yet. The cost of education has skyrocketed, far outpacing inflation for years. You need to be brutally honest about the return on investment for your chosen degree and career path. Sometimes a lower-cost option, like starting at community college or choosing a state school over a private one, can save you a lot of long-term stress and tens of thousands of dollars in debt that takes decades to pay off. The key is to run the numbers and treat education like the massive financial decision it is, understanding the total cost, not just the sticker price, and how that debt will affect your monthly budget for years to come. Next, let's talk about income and building your earning potential. Your 20s are a phenomenal time to try different jobs, build a diverse set of professional experience, and learn how the working world really operates. You shouldn't expect your first job to be your dream job, but you should treat it as an educational opportunity. Every experience, from entry-level customer service to an administrative role, helps you understand your strengths, your weaknesses, your interests, and, most importantly, the market value of your time. You are accumulating career capital, which is your skill set and experience, and that's what makes you valuable to future employers. As you gain experience, make it a point to research salary bands for your role and industry. Use professional networking and websites like Glassdoor or LinkedIn to understand what similar, successful positions are actually paying. Don't be afraid to negotiate your starting salary and ask for raises as you earn them. Remember, your employer will almost always pay you the least amount you're willing to accept, so you have to advocate for yourself. Many young professionals leave thousands of dollars on the table simply by not asking for more. By the end of your 20s, you should be focused on identifying a field you genuinely enjoy and where you can specialize, because staying in one industry and becoming an expert long-term often leads to much higher earning potential than constantly job hopping for minor salary bumps. The most powerful long-term way to build wealth is to consistently increase the gap between what you earn and what you spend. Once you're earning money, there's a critical three-part milestone that sets the tone for your entire financial future: delaying gratification, staying out of credit card debt, and building strong credit. Delayed gratification is simply the superpower of pausing before impulse purchases and consciously choosing long-term benefits over short-term wants. It's the habit of saying no to an expensive gadget or daily takeout so that money can compound into a much larger retirement account later. When you get a raise, this is the most dangerous time for your finances. Don't immediately upgrade your car or apartment. Instead, let that extra money go straight to savings or investing. This phenomenon is called lifestyle inflation, which is when your spending increases immediately with your income, and avoiding it is a superpower that few people master. Keep your costs low as your income rises, and you'll be wealthy before you know it. On top of that, credit cards can be great tools, but only if you use them responsibly. Interest rates often sit around 18% or higher, compounding daily, so carrying a balance from month to month can hurt your finances fast and essentially negate any progress you're making in other areas, even if you're investing. The only goal is to pay off your balance in full every single month. Treat it like a debit card. Doing that not only keeps you out of expensive debt, but it also helps you build a strong credit score, known as your FICO score. A strong credit score, anything in the mid-700s and up, leads to much lower interest rates on big purchases like car loans and mortgages later in life. This is where the real money is saved over the long haul. Even a small difference of 1 or 2 percentage points in an interest rate can cost or save you tens of thousands of dollars over the life of a 30-year mortgage. The golden rule is to never miss payments. Set up autopay, set calendar reminders, whatever works for you. Just don't miss payments, as your payment history is the single biggest factor in your credit score. Try to keep your credit utilization, how much you're spending versus your limit, below 30% and ideally below 10%. Another huge, tangible milestone is building a targeted savings goal. This could be saving for a house down payment, funding a wedding, taking a dream trip, or even building seed money for a future business idea. Having a clear, emotional goal helps you budget with purpose and makes the short-term sacrifice feel worthwhile. It gives you a strong reason to deny yourself those smaller, fleeting wants. A helpful habit during your 20s is relentlessly keeping your living expenses as stable as possible while your income grows. You want that gap between what you earn and what you spend to become wider and wider over time. That ever-growing gap is the fuel for everything you'll want to do later in life, whether it's financial independence, early retirement, or just having the freedom to change careers without financial stress. Speaking of budgeting, one simple, effective approach many people use is the 50-30-20 rule. That means 50% of your income goes to needs like rent, minimum debt payments, and utilities, the essentials. 30% goes to wants like entertainment, eating out, and subscription services, the fun stuff. And the final, non-negotiable 20% goes directly to savings and investing. A great first step to implement this is to do a detailed spending audit. Go through your last 3 months of bank and credit card statements and label every single expense as either a need or a want. It takes a little time and can be a humbling experience to see exactly where your money vanishes, but it is incredibly eye-opening and genuinely helpful for figuring out where you can painlessly cut spending to immediately free up money for your 20% savings goal. Knowledge is power here, and knowing where your money goes is the first step to controlling it. Once you've paid off high-interest debt, set up a realistic budget and built an initial emergency fund, which is typically 3 to 6 months of essential living expenses kept safe in a high-yield savings account, you are finally ready for one of the most important milestones of all, investing for the long term. For most people, the easiest and most powerful place to start is with tax-advantaged retirement accounts. In the United States, that usually means a Roth IRA, a traditional IRA, or a 401k through an employer. These accounts are special because the government gives you huge tax breaks for using them, essentially giving you a financial head start. A Roth IRA is especially valuable for people in their 20s because you contribute money you've already paid taxes on, and then the money grows completely tax-free for decades. You won't owe a single penny of taxes when you withdraw it in retirement. Since most young professionals are in a lower tax bracket now than they will be later in their careers, paying the taxes up front makes a lot of sense. A 401k is also powerful, especially if your employer offers matching contributions. This is the closest thing to free money you will ever get, often a guaranteed 50% or 100% return on your money up to the match limit, And if it's available, you should absolutely take advantage of it. Leaving a match on the table is the biggest mistake a young investor can make. At a minimum, invest enough to get the full match. After you've chosen your accounts, the next step is deciding what to invest in. For most long-term investors, low-cost index funds or exchange-traded funds, or ETFs, are the simplest and most effective choice. When you buy an S&P 500 index fund, for example, you instantly own tiny pieces of hundreds of America's largest, most successful companies. This strategy is automatically diversified, which reduces your risk and historically has grown steadily over long periods of time, allowing you to participate in the growth of the overall economy. Look for funds with extremely low expense ratios, the fees you pay, to maximize your returns. The key to success is staying consistent and staying invested. Timing the market, trying to guess the best time to buy or sell, almost never works, even for professional investors. The truth is, most of the very best days in the stock market come right after the worst days, often during periods of high fear and panic selling. Missing just a handful of those sudden, powerful good days can massively reduce your long-term returns. That's why the adage is true: time in the market is more important than timing the market. Keep automating your investments, keep buying consistently through good times and bad, and let compounding do the heavy lifting for you. This discipline, often called dollar-cost averaging, is the difference between an average retirement and a comfortable, secure one. Finally, the ultimate milestone in your 20s is getting your foundational documents in order. This isn't a fun topic, but it is essential for a stable financial life. This means writing a simple will, even if you don't think you have enough assets to need one yet. Establishing power of attorney for both medical and financial decisions. Setting up beneficiaries on all your investment accounts, bank accounts, and insurance policies, and possibly getting some basic life or disability insurance, especially if you have a significant other or any dependents relying on your income. You want to make sure the money you've worked so hard to save goes exactly where you want it to, minimizing stress and legal complications for your loved ones, no matter what unforeseen events occur. Think of this as protecting the entire financial structure you've built. If you stay patient, invest consistently, avoid emotional decisions during market volatility, and build these solid habits now, you will likely look back decades from now and be incredibly glad you started early. The power of compounding when you're young is truly a financial miracle that can turn small, consistent contributions into massive wealth. Thanks so much for watching. If this video helped you understand the financial roadmap for your 20s, please don't forget to like, comment, and subscribe. It really supports the channel and helps others learn the financial skills they've never been taught. I appreciate you being here, and I'll see you in the next lesson.